I'm Andrew Zarnett, Managing Director, head the gaming practice at Jefferies. SPACs continue to be a significant part of the IPO market. In fact, SPAC IPOs totaled $151 million, representing 62% of the overall IPO market. Year to date, there's been 559 deals. That's up from 248 deals in the prior year. Most of those SPAC IPOs were in the first 4 months of 2021, with a dry spell for a few months and then a pickup since Labor Day. Today in the market, there's 548 SPACs that are currently looking for targets. 118 transactions have been announced, but not yet closed. There have been 39 deals announced since Labor Day. 78% of those announced deals have a PIPE, and a PIPE is a private investment in a public company. A cautionary note is that 75 of those 118 announced deals are trading below their cash and trust. That would be the cash value in that SPAC. So today, while not what it was in the first quarter of 2021, the SPAC market has regained a footing both in terms of issuance and transactions. SPACs are extremely effective for high growth companies that demand a higher valuation. In that case, current revenue growth is the driver of valuation versus cash flow generation. And merging with a SPAC allows that target or that company that will be merged, so for example, DraftKings, to release forward projections, making it easier for all parties to do due diligence. The product works extremely well for growth companies. We have seen a lot of these high growth companies, as well as gaming companies such as Golden Nugget, Rush Street, Genius Sports, and of course DraftKings and more in the space. It is not the only route to go public, but for some, it is a value-added proposition in that you're able to utilize a number of factors to help you in making that transition from a private company to a public company. Given that SPACs are a vehicle for companies to go public, the answer is clearly no. They still allow and provide for companies to go public. The real question really is valuation. Valuation is the key. You need to have a valuation that works for the company that's being acquired, but also for those new shareholders that will own that stock coming out of that public listing. So, other issues in addition to just value matter. I mean, you need to look at the quality of the SPAC. You need to look at the experience of the SPAC in terms of targeting an industry, sort of such as TechCorp, run by Matt Davey. You need to look at the cash on the balance sheet, which effectively we call the cash and trust. You need to look at the governance. Will you have any assistants running as a public company? You need to look at that SPAC management team, the quality of the team, the industry experience, the M&A experience they have. And really, a SPAC is an alternative to an IPO. It offers, for many, greater flexibility. It allows buyers to look on a forward basis by providing those earnings in terms of the due diligence. And it's extremely useful for complicated transactions. If you go back and you look at the DraftKings transaction, that included the merger of SB Tech together with DraftKings that then went public. And those transactions are difficult. SPACs enable that to occur. You actually have the opposite of headwinds right now. You have 548 SPACs that are out there looking for targets. That that alone guarantees their popularity. Valuations will have to be reasonable, given that they need market acceptance to be able to work. But that would be true of an IPO as well. So whether you choose an IPO or a SPAC, valuation is important either way. In terms of the success of SPACs or the number of SPACs out there, 2021 year to date, there's been 559 new SPAC IPOs. And in the last 4 weeks, 52 additional SPACs have priced, SPAC IPOs have priced, for cash of a total of $13 billion, looking for assets valued at $65 billion. The backlog, so those that are continuing to want to IPO SPACs is 296 for proceeds of approximately $64 million, and looking for companies of total valuation of $250 billion. So SPACs are out there. SPACs do provide an alternative to a traditional IPO. There's a lot of flexibility, and they will continue to be accepted as long as they actually look for valuations of companies that make sense.